Hi, Cindy Carava here with Coldwell Banker Millennium. I'm back again with my good friend Greg Burns. Greg, can I use my 1031 to buy my dream home?
You can actually. So we're seeing a fair number of people do it right now. I mean, so you have those baby boomers are getting older, they're looking for places to retire. And so the rule with 1031 is that you got to sell investment property, right? Buy an investment property. So you say, well, how does that work for my dream home? So it doesn't say that you have to hold that property as an investment forever. It just said that your initial intent when you purchased the property had to be to hold it for investment. So there's a revenue ruling out there that says any property that's been held for 2 years or more as an investment, the IRS won't challenge the held for investment portion of the exchange in an audit. So as long as you hold the property for an investment for 2 years, and it could be, a full-time rental, it could be a vacation rental, but as long as you hold it as an investment, it'll qualify under Section 1031.
Awesome. Another question I had, Greg, was how do taxes work if I convert my 1031 property into my primary residence?
This is a good question, actually. We get that quite a bit. So the way it basically works is that, when you exchange a property, you're deferring taxes, right? They're not tax-free exchanges, so the taxes are still there. And then you say, okay, well, there's a tax code, which is Section 121, which says if I live in a property for 2 out of the last 5 years, I can take up to $250,000 of gain if I'm single, or up to $500,000 if I'm married. So if I exchange into a property and then convert it into my primary residence, can I take my primary residency exclusion? And the answer is kind of. It used to be a huge loophole in the tax code where somebody would, essentially, there's this old lady named Gladys who's a great story, who sold an apartment building, bought 5 single-family residences, and then after she rented them out for a while, she just kept moving to each one every 2 years to take her residence, because you don't want to pay any taxes, right? So they kind of saw that as a loophole, and so what they did is they changed it. They said, okay, if at some point you convert an property that you exchanged into your primary residence, you basically have to own that property for at least 5 years before you could take your primary residency exclusion. So if I rented it out for 2 years, lived in it for 3 years, at the end of that 3-year term when I owned it for a total of 5 years, I could sell it, and they're going to prorate how much of it I can take. So they're going to prorate it off 2 years of non-qualified use, which is the time that I rented it out, versus 3 years of qualified use. And they'll prorate it based on that. So obviously the longer that you live there, the more of the exemption that you can take. But certainly, I think people are going to take advantage of that and will, be able to go from tax deferred to kind of tax free.
Okay, great. Good to know. Thanks, Greg, for doing this episode today. And if you have any questions, please feel free to leave us a comment. Have a great day.